The Reserve Bank of India has cut its key repo rate by 25 basis points to 5.25% in line with expectations, and this marks a total reduction of 125 basis points since February 2025. The move coming amid record low retail inflation, which fell to just 0.25% in October, and a strong GDP growth of 8.2% in the July to September quarter. Listen to this.
The MPC voted unanimously to reduce the policy repo rate by 25 basis points to 5.25% with immediate effect. Consequently, the STF rate under the LAF shall stand adjusted to 5% and the MSF and bank rate to 5.5%. The MPC also decided to continue with the neutral stance.
The 6-member Monetary Policy Committee voted unanimously for the cut while maintaining a neutral stance on policy to support liquidity. The RBI will conduct 1 lakh crore rupees in open market operations and $5 billion in forex swaps this month. A repo rate cut lowers the cost at which banks borrow from the RBI, basically. In the current economic context, this is aimed at boosting growth further without stoking inflation, which remains well below the RBI's 4% target. For everyday consumers, this generally translates into lower interest rates on home loans, personal loans, EMIs. Businesses may also benefit from cheaper credit, encouraging investment and expansion. However, the impact on loans depends on how quickly the banks pass on the rate cuts to the borrowers. The RBI governor, meanwhile, called the current period a rare Goldilocks phase with strong growth, low inflation, and robust rural and urban demand. Investment activity is gaining momentum, supported by rising private investment and high capacity utilization. With inflation expected to remain soft and credit availability improving, the rate cut aims to sustain domestic demand and economic expansion. Meanwhile, the RBI has projected real GDP growth at 6.8% for 2026, with quarterly growth gradually moderating but remaining healthy into the next fiscal year. And for more on this, with us on the broadcast is Subhash Chandra Garg, former Finance Secretary of India, with us from New Delhi. Thanks very much for being here. I have to ask you first, how, according to you, will this rate cut actually impact everyday consumers in terms of, say, their EMIs or their home loans and even personal loans?
So the most direct connection is to the EMIs of the housing and the other consumer durable loans, because in our system now about 60% of these loans are directly connected or linked to the RBI's repo rate. So as this comes down, those rates will also reduce. But remember, we are still in the cycle at about 5.25%. And this whole thing started in May 2022, when it was raised from 4% to 4.4%. So at 5.5%, we are still about 1.25% higher. And when the inflation today is much less than what it was in May 2022, I guess there is a lot of reason why the rate should actually be reduced further. And it's not having any adverse impact on the growth, in fact. These are the two categories which have direct benefit, but other consumers don't really get much benefit, because the larger monetary play out in the system, when the general interest rates come down, the borrowings come down, cost come down, and the cost of goods get reduced. That is a very long play. I don't think that makes much of an impact of this 25 basis point cut.
Right. Then let me ask you this then. How do you see the monetary easing actually influencing India's growth? in the face of those global uncertainties, also the US tariffs?
See, the growth impact comes through the channel of interest rate reducing, which raises the investment demand. That investment demand then brings the additional growth. But as we are seeing, the credit growth is not that high, and the credit growth in the industries and infrastructure segment, which makes the biggest impact on the growth, is still not picking up. The private investment is quite subdued, so it's very difficult to sort of make a case that a 25 basis point cut can have very major or good impact on the growth. So growth, to my mind, remains largely. The second channel is through the consumption channel, that if people borrow more to buy goods and services more, that is also showing a subdued kind of response. The loan growth for personal side, including housing, credit, except credit card, housing and other durable, is also a little bit subdued. So I don't see a very major impact of the rate cut on the growth as such.
Okay, so with the rupee at historic lows, how would the RBI balance growth, inflation, and currency stability also in its policy, according to you?
The RBI has to deal with the currency stability. The additional measure taken today of doing the dollar-rupee swap deal is intended to sort of give signals to the importers that, all right, you sell the or exporters, that you sell the exchange today, foreign exchange today, and you can have a prefixed purchase after it whenever you need it. So the RBI is trying to manage this. It's also trying to ensure that the dollar or the rupee does not depreciate much against the dollar, but it's not being successful in that. So it's a very fine balance as far as the foreign exchange rupee depreciation thing is concerned. I think RBI would be happy if it's able to sort of manage the rupee depreciation in a very orderly, gradual way. 5.5% or 6% depreciation in a 7-8 months time is quite high. That's not that shouldn't be the case when you have a high growth economy and the low inflation economy. At that time, your rupee should actually be appreciating, but it's not happening. Therefore, there may be other fundamental reasons which are putting pressure on the rupee. So it's trying to do a job, but I think with whatever firepower it has, both of policy as well as the reserves, if it is able to manage an orderly depreciation, that should be good enough for the RBI.
All right, we're leaving it there for the moment. Thanks very much for being here and sharing those perspectives.
Thank you.